So I don't normally do videos on Saturday, but I'm doing this for you guys, giving you an extra video this week. And today I'm going to help some people with their investing journey. I saw on a video that I did around about 2 days ago, some investors making a really big mistake, and I thought I'm going to help these investors, because if I don't help them, they're probably going to continue to make these mistakes and it will probably end up costing them a lot of money. Now, if you've been following the channel for a while, if you've been following before 2020, 2018, 2019, even you guys that have been probably investing since 2021, maybe even 2022, you probably will know this. So this video probably won't be for you, I think. If you're a new investor, so you started investing maybe in 2022, 2023, or even 2024, this might be the first couple of months you've been investing, this video is going to be really helpful for you guys. And that's what I try and do. I always put these videos out to try and help you become better investors. So I got this comment on a video that I did 2 days ago when I did the video on Daniel Pronk's picks, and the comment said this. So it came from Citizen86, which I'm guessing is a newer investor into the market. Said Melly at a P of 77 times is not a bad valuation. Average is 15 to 20 times, and even with their forward guidance is very rich. Now, there was someone, A-Ban Rocks, which I know has watched the videos for a while. He did try and help them, but obviously I'm going to try and give a little bit more detail than his comment right there. And also there was a comment from someone called Alex who said that Melly at PE of 77 times earnings is not a bad valuation, trying to understand it. I'm guessing, once again, a relatively new investor, so I'll try help him as well. And Andy Pickering, which we know is a new investor as well, because obviously he struggled with the opportunity of HIMS only 2 years ago. So I know Andy's a bit of a new investor. So I'm going to try help these three guys to understand the concept of a earnings ratio and to the projection of growth and paying up for growth, and how much do you pay up for it. So as well as helping these three guys that are new investors, if any of you guys are new investors, I hope this video is helpful for you as well. And if you could hit that like button, that's absolutely amazing. So first of all, let's talk about the average, the first bit. So an average company that grows 3 or 4%, that's about the average growth. That's about what GDP growth at, and that's actually, if you look at the average growth of most years, that's what happens for most public companies. They grow around about 3 or 4%. So these stock companies normally trade around 15 to 20 times earnings, which is the reference there. And that's normally what the S&P trades at, because there's a lot of average companies in the S&P 500. Now, sometimes the S&P can trade higher than that when it gets a little bit frothy, but that's what it should trade at. So most companies should trade between 15 and 20 times earnings. Sometimes you'll see some go above 20 times earnings, even though they're an average company. So they might grow the same sort of 3-4% a year on average. Look at Nike. Nike can sometimes be around there, sometimes a little bit more growth, but Nike will always trade a bit more of a premium than the average company because of its brand. Sometimes companies are rewarded a little bit more in valuation if it has a good brand. So Nike, you look at, is Nike going to be the fashion leader in sports for the next 10, 20 years? More than likely. So it puts a bit more of a premium because of the moat around there. So there's sometimes where rules are broken. That's an example there, but not what I'm going to focus on today, because that's getting a bit too more complicated, and I want to keep it a little bit basic for some new investors. So I've picked three companies here. So I picked Diageo, Amazon and Melly, because Amazon was in the reference of the video and Melly was in the reference of the video. I put Diageo in here because Diageo is the average company. I wanted an average company here. So Diageo trades around about 20 times earnings, the average valuation. If you look at what Diageo normally grows at, it normally grows around 3 or 4% a year. Now, technically this year it's growing a little bit slower. It's actually got negative growth this year, but average will probably come around 3-4%. Amazon doesn't trade at the average valuation. It trades at 63 times earnings. The average growth of Amazon is around 10 to 12%. So it's a lot lower, a lot higher than where Diageo is. It's over triple. Mercado Libre trades at 76 times earnings, and it grows at 20 to 30%. Now, first of all, if you just ignore the earnings basis here, if I said to you, I've got a company here that's going to grow at 3 to 4% a year, and I've got a company here that's going to grow 10 to 12% a year, and I've got a company here that grows 20 to 30%, which one is going to be more valued? Which is going to be higher value? It's going to be Mercado Libre, isn't it? You're going to value Mercado Libre higher than the other two because it's growing more. It's growing nearly 5 times what Diageo is going to grow at. It's growing nearly double what Amazon's going to grow at. So Mercado Libre, first of all, is going to be valued higher than the other ones. Imagine if this Diageo was 20 times and Amazon, let's say Amazon was 20 times the market value, or the market average, and let's say Melly was 20 times, you're not going to buy Diageo, are you? If you're seeing Amazon growing triple what Diageo is, you're not going to be buying Diageo. If you see Mercado Libre growing 5 times Diageo, you're not going to buy Diageo if that's 20 times earnings and that's 20 times earnings. It's just not going to happen. The market is not going to put a above average company at 20 times earnings because it's a premium company. The market is going to start, if you saw a company like Mercado Libre at 20 times earnings, right? It's clear as day it's probably going to be an absolute mega buy. So that's why it's never going to happen, because the market's going to be thinking, well, I can get Diageo at 20 times or this at 20. It's not going to happen. So that's why the market starts factoring, well, this is going to grow a lot faster, so I'm going to start valuing that a little bit more. That's what happens in the stock market. Now, I'll keep this really brief because then you start getting onto the profitability side as well. But I just wanted to give you an example there of the growth and how people would value growth. You're trying to project what growth they're going to do. So that's going to be valued more, because in a few years, that's going to be a lot bigger business. Or it's going to drag all its metrics for what do you have to have a successful business? It's profit growth and revenue growth. If your profit growth and revenue growth is a lot better, you're going to be valued more, aren't you? That's the first thing. Okay, so let's put it into context once again. So 2024, let's say all these businesses are equal: 500 million, 500 million, 500 million. If Diageo grows at 3%, if Amazon grows at 11%, if Melly grows at 25%, I think those are the figures I used. I did it last night, so I couldn't remember them exactly. By 2029, and don't forget, we're all investors here. That's what investing. We are investing for the future. That's what we're doing. So if we go to 2029, the revenue that Diageo will do is 610 million. The revenue that Amazon will do is 864 million. So that's why you're going to pay more for Amazon, because it's going to be doing more revenue or profit than Diageo. When you look at Mercado Libre and you look at their numbers, they're going to do 1,722. That's compounding. Compounding for 5 years, the growth is absolutely crazy. So this is why you'd be a lot more willing to pay something up for Mercado Libre than Diageo or Mercado Libre than Amazon, because when you start compounding at higher growth rates for a long period of time, which we are trying to do, this is going to be absolutely crazy. This is going to be doing so much better numbers, and that's what you're trying to work out. You are trying to work out in 2029 or whatever time frame it is, what is that company going to be doing on a numbers basis? And you look at today's numbers and you go, actually 76 times earnings does look expensive right now. But if you start looking at the numbers and you start working out, but if I hold this for 5 years' time, actually this looks relatively cheap to the numbers they're going to be doing. And that's investing. That's investing, because you're looking at that number and you're thinking, well, there's a lot priced in here at the moment. It doesn't look cheap in 2024. It doesn't look cheap for 2025. But the rest of the years, it doesn't start looking cheap. And that's invested. You're trying to work out how much growth is priced in. And if very quickly, you only have to wait a year of that investment before it starts looking relatively cheap, and then by the time you get to 25, it looks very, very cheap, you're going to look a genius. And that's what invested is. It's kind of working out how much growth is priced in here. That's why it's a lot easy to work out something like Diageo, for example. It's very rare you get a company like this at these sort of levels, because obviously people look at these numbers and go, 20 times earnings for that? Obviously I'm going to buy it. It's very rare, PayPal, that you get a company like that with hyper growth. It just doesn't happen. And this is why growth companies are a little bit trickier to invest in, because you're trying to predict a lot more future growth priced into the numbers. That's why growth investing is quite hard to invest in. Now, this is the other curveball. So that was a little bit more basal, like revenue growth. Ultimately, there's two things you need to have a successful investment. You need to have revenue growth and profit growth. So it depends what profit growth or profit margin the companies are throwing off. So for example, if let's say Diageo throws off a 10% profit margin, which I think it's actually higher than that. Amazon is 10% profit margin. I'm just using these for example. These aren't actually the profit margins, but I just wanted to kind of keep it basic for you guys to get your head around. 10% profit margin, 10% profit margin, and Mercado Libre does a 10% profit margin. Okay? If they all do them profit margins, then obviously this looks an absolute steal. But also what you might start factoring in is investing. We're looking at 2029. So if I look at 2029 and Diageo still does a 10% profit margin, okay. Amazon still does a 10% profit margin, okay. But if I look at Mercado Libre and it's currently doing a 10% profit margin in 2024, but Let's say by 2029, that profit margin is going to scale up to 20%. Then you're like, hold on. It's not only going to be throwing off more profitability, it's also going to be increasing the profitability margin. And historically, that's also going to be very good amounts of profitability it's going to throw off. So now that opportunity looks even better. And also, when you're investing, that's what you're investing for. You're trying to predict the revenue growth, you're trying to predict the profit growth, and then you're also trying to predict profit margin. If that profit margin expands, that's absolutely amazing. And when you look at Mercado Libre right now, for example, which I was referring to yesterday's or 2 days ago video, they're only just getting started on the profit margin. Their profit margin is going to ramp up a lot more. It's going to ramp up a lot more than Amazon. So when you look at something like a Mercado Libre, this goes back to the first comment on what the video was based on. So you look at Citizen's 86 comment about Melly P at 7 times earnings, not a bad valuation. Well, yes, it would be if it was growing the market average valuation, but it's not. Average is 15 to 20 times earnings. Yes, for an average company. This is not an average company, remember. You got to look at the growth. And you look at Alex Edwards' comment, who I think is, once again, like I said, a new investor, a little bit confused around how Melly is a higher valuation, but is a better opportunity than Amazon. When you compare the two stocks, sure, on an earnings basis, Melly is a lot higher valuation than Amazon. However, it's growing more. When you look at the compounding, that's going to very much reward the stock. When you look at the profit margin on Mercado Libre is higher than Amazon, and in the next 5 years, the profit margin is probably going to end up being a lot higher than Amazon. In fact, it already is higher, and that profit margin on Mercado Libre in the next 5 years will expand more than Amazon's. And once you get more compounding, higher growth, higher profit margin, expanding profit margin, this is where you start running, remember, 2029. Investing is thinking about the future. If you start looking at 2029 and look at the numbers that Mercado Libre are going to do, you start looking at the potential profit margin, you look at the growth, does it look cheap at 76 times earnings now? And that's where the video yesterday, where maybe I should go into it in a little bit more detail and people might not have got confused about it. When I went on the video yesterday, that's why Mercado Libre doesn't look a bad valuation right now, because Amazon, looking at their profit margin not expanding and their revenue growth at these levels, looks okay. I think you still make money. Mercado Libre with over double the growth and expanding profit margin and maybe a little bit of a higher times earnings, when you start running those numbers and that's what you're investing for, you're looking at the future. And in my opinion, if you start looking at 2029's numbers and what Mercado Libre could potentially do, and you look at today's valuation, I think you make money if you hold this for the next 5 years. And that's about investing, guys. Future thinking. Not looking at the numbers right now. There's no point looking at numbers right now. That's not investing, guys. If you look at the numbers today, if you look at the numbers they're going to do in 2024, you're not investing, guys. You're not investing. Investing is about buying something and holding it in the future and trying to predict where it's going to be in the future and if that investment is going to be worth more. Is that investment you investing going to be worth more in the future? That's investing, guys. That's what you need to look at. So hopefully this video for Citizen 86, Alex and Andy, hopefully this video is helpful for you guys, and as your journey starts as new investors, hopefully this is a little bit more useful for you to try and not make a mistake on getting caught up on earnings and trying to value a company and making sure you're not valuing a company off today's numbers. You know, you're an investor, guys. You got to look at the future, and hopefully this video helps you guys, okay? Anyway, that's the video for today, guys. Have a good weekend, and I'll try to do a video tomorrow on the UK stocks I'm buying, and hopefully I can make it through a longer video than today, because it was a bit of a struggle at the end. Anyway, hope you enjoyed it. See you in a bit.